Welcome to Early Edge Club. Before we deep dive, we are opening Early Edge Club to a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company that we are analyzing today is Freshara Agro Exports. So Freshara is a company that specializes in the manufacturing and exports of various pickles with a primary focus on preserved gherkins. Gherkins are their flagship products, contributing the majority of their revenue, and they are currently a 100% export-oriented business. Now, this slide shows a few of the products that the company offers. They deal in a variety of pickled vegetables beyond just gherkins. Now, on the product-wise basis, gherkins remains the dominant contributor, accounting for 82% of the total revenue. The remaining 18% comes from a diversified mix, including baby corn 2% and other pickled vegetables like lentil, chilies, bell peppers, and jalapenos. From a geographical perspective, Spain leads with 20% of the revenue, followed by Russia at 16.2%, Iraq at 11%, Chile at 7%, and Italy at 5%. The remaining 39% is spread across other global markets, indicating a well-diversified export base across both developed and emerging economies. Now, here you can see the different packaging formats they use. They offer products in bulk and pails for industrial use, as well as retail, food service, and industrial packaging options. They source their packaging materials from well-known listed companies such as Time Technoplast for plastics and AGI and Hindustan National Glass for glass products. This helps keep their packaging costs stable with minimal price appreciation of only 1 to 2% annually. Now, the company's raw materials are primarily sourced through contract farming with over 4,000 farmers. This model provides a fixed price to the farmers, which in turn helps company maintain stable procurement costs across years. By sourcing from farmers spread across 3 states, they also hedge against any negative impact from localized climatic issues on their crops. Now, the company has 2 manufacturing facilities, both located in Tirupati, Tamil Nadu. The first plant currently processes 50 metric tons per day. The second plant, which became operational in January 2025, is expected to operate at less than 50 tons per day initially and at 50 to 60% utilization in FY26. This new facility will scale to 100% utilization in FY27. Now let's turn to the broader industry. So India's gherkin industry began in the 1990s and has since become a global leader, accounting for 15% of the world's production. It supports over 90,000 farmers and includes 51 major exporters. India is now the world's largest gherkin suppliers, exporting to over 90 countries. This growth is driven by low production cost, a favorable climate, and increasing global demand. This niche industry also plays a vital role in rural employment. Within this industry, our company, Freshara Agro, is a key player, either the second or third largest, with Global Green being the top player. The management believes that India has one of the best quality gherkins in the world compared to Vietnam and other exporting countries. Now let's see the management overview. The company is led by a dedicated management team. Chairman and MD, Mr. Junaid Ahmed, with over 9 years of experience, leads the strategic direction. He works closely with whole-time directors Mr. Iqbal, but and Mrs. Asma Sayed. This team expertise has been crucial in scaling up operations and transforming the company into a globally recognized exporter. For context, Mr. Junaid and Mrs. Asma are a married couple, and Mr. Iqbal is Mr. Junaid's father, making it a very closely knit leadership team. In the con calls, also the MD and chairman, Mr. Junaid, was answering the con calls. He was very detailed while explaining the con calls and everything and giving answers to all the questions that all the analysts were asking. So overall, the management is really good. Finally, let's take a look at the historical performance. As you can see, the company has shown good and steady growth in both revenue and profit over the years. The margins have also been good. The financial figures for the last year appear anomalous, anomaly you can say, with lower revenue and higher margins. This is due to a change in accounting rules after the company transitioned from a partnership fund to a limited company and got listed last year. We should expect to see normalized figures going forward because this was a one-time change. Now let's look at the operational highlights and the key takeaways of company. So the new facility is operational. The company has successfully brought its second manufacturing facility online. This impressive 8-acre facility boasts a processing capacity of 75 to 100 metric tons per day and a scalable retail packaging line capable of producing about 18,000 jars per annum. Then we have the stable margins. So the company consistently maintains healthy margins of 10 to 15% on its products. This stability is largely attributed to their contract farming model, which ensures a fixed price for raw materials and consistent procurement cost. Furthermore, they can pass on fluctuations in global freight cost to customers, maintaining stable margins even during price changes. Then, Taro operates primarily as a B2B supplier, specializing in white labeling for customers rather than developing its brand. Essentially, they are a raw material supplier to the global market. They hold a significant position in the gherkin industry, contributing 15 to 20% of the global supply and holding a market share of 10 to 14%. And lastly, there is a positive financial outlook. So the company anticipates a 30% revenue growth. For the next 2 years, they are projecting a healthy PAT margin of 14 to 15% and an EBITDA margin of 18%. Now let's explore why the company presents an exciting opportunity. So significant returns on investment and capacity expansion. The recent investment of 30 to 35 crores, largely completed, is projected to generate substantial sales of 200 to 250 crores. This new capacity is a game changer, with the second plant expected to reach a peak performance of 150 metric tons per day, significantly boosting overall production capabilities. Then we have the resilient cost structure. The company's reliance on contract manufacturing for raw material sourcing provides a robust and predictable cost structure. This insulates them from significant price fluctuation, ensuring consistent and stable margins. Then, currently, retail packaging contributes less than 20% to its business. However, management has indicated that increased retail packaging leads to better margins. This presents a clear avenue for future margin expansion, supported by stable packaging material costs due to procurements from listed companies. And lastly, the strong and consistent demand. Freshara Agro Exports boasts a current order book of 82 crores and anticipates securing orders of around 80 crores every quarter. This strong and consistent demand underscores the market's need for their products and their ability to capture significant business. Finally, let's consider the potential challenges and risks. So, global freight cost volatility. While the company has a mechanism to pass on freight cost to customers, a substantial and prolonged increase in global freight charges could still impact working capital requirements or make its products less competitive in certain markets, even if margins are stable. Then we have the agriculture vulnerabilities despite diversification. So, although the company sources from 3 states in South India and deals with 6 to 7 different vegetables, providing around 250 days of raw materials supply, unforeseen extreme weather events or widespread crop disease would still disrupt the supply of raw materials and impact overall productivity. Then we have the concentration risk in B2B white labeling. A company's primary focus on B2B white labeling means its performance is heavily reliant on the demand from its key customers. A significant downturn in demand from these clients or heightened competition in the white labeling sector could negatively affect their order book and revenue. Lastly, utilization rate of the new facility. The second plant is projected to operate at 50 to 60% utilization in FY26 and reach 100% utilization in FY27. Any delays in achieving this utilization targets or a slower than anticipated ramp up could directly impact their projected revenue and overall profitability. So now let's see the company through our framework. So section one, see, so they had a fresh issue raising 75 crores, out of which most of it went to working capital, some of it went to capex also. So because most of it went to working capital, I gave a 3 on 5 score. Titan promoter track record is good. They only have the majority of the stake holding. So there is no bad remark also about them. So I gave a 5 on 5 score. In related party transactions, so there were some related party transactions such as 3 crores of purchases, capex from concrete builders. Concrete Builders is a company in which the MD and whole-time directors are partners. So that is also another partnership firm only. And then there were borrowings from our chairman and MD of 19 crores. I did not find the interest rate which the MD is charging from our company. So because of that, I gave a 3 on 5 score because the amount was a bit big. Now, board composition, if we say, it is almost 50-50. 3 are independent directors and 3 are family on board. So I did not find any issue in that. So I gave a 5 and 5 score. And let's see the remuneration. So remuneration is also been fine. So that is why I gave a 5 and 5 score there also. Now, key person resignation, only one, the company secretary had resigned. But the reason I gave 3 on 5 was there was no particular reason mentioned for her resigning. But she was appointed in March of 2024 and she resigned in June 2024, just before the IPO, I think. So that is why I found it a bit odd and the specific reason was also not mentioned. So that is why I gave a 3 on 5 score here. Then the auditor resignation, there were no auditor resignation, so I gave a 5 on 5 score. Auditor opinion, because the annual report is not yet out, so auditor opinion is not found. So credit opinion has been good. It has been CRISIL triple D for long term and CRISIL A3 plus for short term. So I gave a 5 and 5 score. I did not find any legal or regulatory issues also. So I gave a 5 and 5 score. Even in investor communication, PPTs, phone calls, annual report. Annual report is not yet out, but still I gave a 5 and 5 score because PPTs and call calls were there. Now to section 2, concentration risk. So the reason why I gave 0 here is the top 10 customers are more than 40%, contributing more than 40% of the revenue. And secondly, gherkins may make more than 80% of the revenue. So as I mentioned in the risk, because they are dependent on one crop only, any problem in that crop related to climatic condition or anything, it can impact that. So that is why I gave 0 and 5 because the product is also very concentrated. The revenue is concentrated on one product. And top 10 customers also contribute more than 40% of the revenue. Cash flow by EBITDA. So the company has had negative operating cash flow despite reporting profits due to working capital intensive business model. This is driven by high inventory and receivables from rapid sales growth, along with limited credit from suppliers. Meaning cash is tied up in the business cycle. Capital expenditure for the new facility also absorbed available cash, which is common for fast-growing agri exporters. So that is why, because it was negative last year and this year it has been 0, so I gave a 0 on 5 score here. And revenue growth versus receivables. So because receivables as a percentage of revenue was high, I gave a 3 on 5 score here. Receivables growth has not been high, but as a percentage of revenue, it is a bit higher. So that is why I gave a 3 on 5 score there. Inventory days has also been on a higher side. So that is why I gave a 3 on 5 score. Cash conversion cycle also has been on a higher side. So their payable days are very less and they are receiving money from their clients delayed. So basically, there is a delay in receiving money and they have to pay early. So that is why all this cash flow problem is also happening. So that's why in the cash conversion cycle also I gave a 3 on 5 score. Fixed price revenue is also good. So I gave a 5 on 5 score. Fixed asset turnover is also good. So that is why. That is a bit high, although they have reduced it by a lot, but it is still high as per our metrics. So I gave a 3 on 5 score. A quick ratio and current ratio has been good. So I gave a 5 on 5 score there. ROE, ROCE, revenue growth, then all the margins, everything has been very stable and very high growth. So that is why I gave a 5 and 5 score in all of them. So after all, the overall score comes out to be 76. And for the last valuation and final take, I'll hand it over.
So before we start, I was just looking at the presentation, and one thing that really caught my eye is how they have grown over the years. So they started around the year 2015-16. So from 4 crores, they have grown to 250 crores, a CAGR of 62%. Production has also grown at a CAGR of 47, and container weight export also around 48%. So they have actually, I mean, it's a really impressive growth that they have had. And coming to gherkins, since I was in UK, I know it is highly consumed, especially by Russians, who I had few of my friends. So there is a market in India, not much. So I can say that the Western countries, people have them a lot. So it's good that India is, the top exporter. So that is advantages for the company. So yes, the management expects next year revenue to be, around this range, 300 crores plus. So let's just take the worst case to be conservative. Yeah, the margins as well around the same 14.67%. So the current PE is 16. Let's just give the same number of 16 or 15. So the price targets comes to 242. Currently, the stock is trading at 204. So given the growth and the PE, remains the same, and the management continues to deliver the way they have done, 1111, see 1112, 126, like the numbers are same. Yeah. So the management continues to deliver the way they have done. I mean, you could expect the price target to be 242 for the next year. Not an investment advice, but just to get an idea as to where the company stands and where the current price is. So yes, they have been operating. I mean, the cash flow from operations have been negative. So last year, it's because of the receivables. This year, the receivables are not is not much. It's more to do with the inventory. So need to keep an eye on these two trends. And since the operating cash flow is negative, let's just take the net profit number of 29. So taking the net profit number of 29 and the required rate of return for us minimum 25, because this is, I feel, it's a bit of a higher risk bet, and our minimum holding period of 5 years and trailing multiple of 10. So to justify the current, I mean, for us to realize 25%, it has to grow its earning as 27% for the next 5 years. The management believes it can grow at 30% next year. They have guided for 30% growth. So it's less than, so we have some margin of safety in the growth rate. And if the PE remains at 15, then the earnings has to grow only at 20%. In that case, you have much more leverage or optionality, I would say. So an interesting company to watch out for. A few things that I would look is to understand the consumption pattern of gherkins, and also they are expanding to other products like corn, etc. And they say that is much more margin accretive. So would definitely keep a track to see how they progress. But again, not an investment advice. So try to know these takeaways and do your own research and due diligence.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-sector scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing And also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.